Have you ever wondered what happens when a market that's been artificially held down for decades finally snaps? I'm not talking about a slow, steady climb. I'm talking about a sudden, explosive repricing that sends shockwaves through the entire financial system. For years, maybe even decades, we've talked about the enormous gap between the paper price of silver, the price you see on your screen, and the reality of what's available in the physical world. But what if that breaking point isn't some distant event we'll tell our grandkids about? What if the system is cracking apart right now, under our feet? Welcome to the Bullion Signal Podcast, the channel where we look at the big picture, analyze the signals in the precious metals markets, and help you understand how to protect your wealth in an uncertain world. Today, we are diving deep into a forecast that suggests we are on the verge of exactly that kind of breakdown. Some are calling it a silver supernova. And in this analysis, we're going to walk through 7 incredibly specific, time-sensitive predictions for 2025 and 2026. If even a fraction of this comes true, the world we know is about to change. So make sure you're subscribed to Bullion Signal because we're going to unpack it all right now. This single question is the key to everything. The entire forecast, all the shocking price targets, they all come back to this simple physical reality. You see, the argument here is that we're witnessing a classic bank run. But instead of people lining up to pull cash out of an ATM, this is a run on physical silver. For decades, the price has been dictated by paper contracts on futures exchanges. These are essentially IOUs for metal. But what happens when the people holding those IOUs start to suspect that the metal isn't actually in the vault? They show up and demand delivery. That's what appears to be happening now. The demand for real, solid, hold-it-in-your-hand silver is starting to overwhelm a system that was built on the assumption that almost nobody would ever ask for the real thing. And the warning signs are everywhere.
So before we get to the jaw-dropping price predictions, we have to understand the foundation they're built on. We need to ask, why now? What signals are suggesting that after all these years of suppression, the game is finally changing? This first section is all about those fundamental indicators. Think of it as looking at the cracks appearing in a dam, the signs that suggest the flood is about to be unleashed.
Okay, let's break down these red flags because they are critical. First, the COMEX vaults in New York, which are one of the most important stockpiles of silver on the planet, have been bleeding physical metal. We're talking about a relentless drain, week after week after week, with millions of ounces flowing out the door. The inventory is simply disappearing. Second, and this is a huge deal, are the reports coming out of the London market. The source material claims that London has had 2 quiet defaults in just the last 6 weeks. Now, what does that mean? It means a large buyer, someone entitled to a huge amount of physical silver, showed up to take delivery and was told, sorry, we don't have it. That is a catastrophic failure in a market that is supposed to be built on trust and physical delivery. And third, we're seeing a massive shift in where the big institutional money is going. This is what the source material is calling the Great Rotation. While we've seen a lot of volatility and downward pressure in more speculative assets, that money seems to be flowing into hard assets, especially physical precious metals. Now, the argument is that this isn't just your average retail investor chasing a hot trend. This suggests that sophisticated, smart money is getting nervous. They're sensing deep risks in the broader system and are moving their capital into tangible wealth, something real. It's a classic flight to safety. And in a market as physically small as silver, that kind of pressure can act like pouring gasoline on an already burning fire. So with that backdrop of a physical market being squeezed tighter and tighter, we can now turn to the short-term predictions. This is where the forecast gets incredibly specific, moving from the why this is happening to the what happens next and, crucially, when.
This quote from well-known market commentator Peter Schiff really captures the feeling of urgency that's building. You know, when seasoned analysts who have followed these markets for decades start using language like hurry up, it's a signal. It tells you they believe the window of opportunity to position yourself before a major move is closing very, very fast.
This isn't just another bullish call, it's a warning that the market is like a coiled spring. And the source material connects this sentiment to a very specific historical pattern. And this is absolutely crucial to understand. This forecast isn't just based on a gut feeling. It's based on a recurring, three-step pattern that has been observed in the past. Let's walk through it. Step 1. The physical stockpiles of metal available for delivery in the warehouses begin to collapse. As we just discussed, that is happening right now. Step 2. The exchange itself starts to get nervous about the volatility and raises the margin requirements. This makes it more expensive for traders to hold on to their paper contracts, effectively shaking out the weaker hands. The COMEX did exactly that just recently. And step 3 is the historical result. Every single time this 1-2 punch has occurred in the past, the result has been a violent price explosion to the upside, usually happening within 48 to 72 hours. The argument being made is that we are standing right on the doorstep of step 3.
And that historical pattern leads us directly to the first, incredibly bold and very time-sensitive prediction from the source, that based on this unfolding explosion pattern, the price of silver will close this week above $62 an ounce. This is the first major domino. It's the first real test of this entire thesis.
Now let's zoom out for a second and look at a critical indicator that really connects the entire precious metals complex, and that is the gold to silver ratio. All this number means is, how many ounces of silver does it take to buy one single ounce of gold? Right now, as you see here, that number is around 77 to 1, but something truly dramatic has just happened to this ratio. And this slide really shows you how significant this is. For the better part of 14 years, this ratio had what you could call a concrete floor of support. It would dip down towards a long-term trend line, but it would always bounce. It never decisively broke. But just in the last few weeks, that 14-year-old floor of support has, in the words of the source, completely shattered. Now, for people who watch market technicals, this is a 5-alarm fire. It's a massive event that signals a fundamental shift in the market dynamic. It suggests that silver is about to begin a period of dramatic outperformance compared to gold.
So why does the ratio breaking down matter so much for the price? Well, because history shows us that when this long-term support level for the ratio breaks, silver tends to outperform gold by a factor of 3 to 1 in the months that follow. That powerful historical precedent is the entire basis for the second prediction that silver is heading for a target between $65 and $68 an ounce, and that it will get there before December 15th of this year.
Now, before we get to the next prediction, we have to define this term because it's a serious one. A market halt is not a normal event. It is the exchange's emergency brake. It's the big red button they push when prices are moving so fast and so violently that they risk losing control entirely, or when they physically cannot make good on their promise to deliver the underlying asset. A halt is a public admission that the market mechanism has failed.
And that brings us to the third prediction, which is arguably the most dramatic short-term forecast of them all, that a major exchange, like the COMEX, will be forced to halt all trading in silver at some point this month. The logic is straightforward. As the physical squeeze gets more intense and the price begins to go vertical, a trading halt may be the only tool they have left to prevent a complete and total disorderly collapse of their exchange.
Now, as incredible as this situation in silver sounds, it doesn't happen in a vacuum. Silver is often called gold on steroids for a reason. Its moves are typically more volatile, but ultimately, the entire precious metals complex is anchored by gold. So now we're going to zoom out and see how the extreme pressure in the silver market is being presented as just one symptom of a much larger systemic problem that's brewing in the global economy.
You know, gold's primary role throughout history has been as a safe haven from systemic risk. And right now, the global financial dashboard is flashing bright red warning lights. For example, in Japan, government bond yields just screamed to decade highs. That's a huge deal because it signals that the multi-decade bubble in global government bonds is in serious trouble. Here in the US, margin debt, that's money people borrow to gamble on stocks, is at a mind-boggling $1.2 trillion. And all of this is happening against the backdrop of a U.S. national debt that is spiraling out of control towards $38 trillion. Each one of these is a major signal of systemic risk, the kind of risk that historically sends investors fleeing to the safety of gold.
This timeline does a great job of putting all of these predictions into a clear sequence. It shows how the immediate, intense pressure on silver is forecast to build over the next few months, leading to a major repricing of gold and eventually culminating in a price for silver that most people, until very recently, would have considered impossible. And that brings us to the fourth major prediction, that gold will reach $4,500 an ounce by January 20th, 2026. Now, why that specific date? Well, that's Inauguration Day in the United States, which is often a time of peak political and economic uncertainty. The thesis is that as all these systemic risks we just talked about continue to build, the flight to the safety of gold will accelerate dramatically, reaching this incredible milestone right around that time. And now, for the final and most stunning predictions, we bring the focus right back to silver. So, if we're in a world where there's a global crisis of confidence and gold is rocketing towards $4,500, what does that mean for the much smaller, much tighter, physically constrained silver market? This is where the simple mechanics of supply and demand lead to an almost unbelievable conclusion. This chart really gets to the heart of the entire issue. See, the world mines and recycles about 950 million ounces of silver every year. But the registered inventory on the major exchanges, that's the actual physical metal that is supposedly available for delivery to contract holders, is less than 160 million ounces. To put that in perspective, imagine a global banking system that only keeps a tiny fraction of its deposits as actual cash in the vault. That's the situation we have right now. There is simply no slack left in the physical system. So here's the breaking point. This is the math that keeps exchange officials up at night. You don't need a majority of investors to lose faith in the paper market. You don't even need half of them. The math is brutal, and it is simple. If just 5%, that's only 1 out of every 20 of the people holding paper silver contracts, decide they want to trade their paper promise for the real thing, the system breaks. The vaults are emptied, the game is over, and this forecast argues we are right on the edge of that 5% moment. So once the price finally breaks free from the paper market and the true reality of physical scarcity takes over, where does it go? The argument is that once silver clears the psychological barrier of $70, the path to the next major milestone is wide open. And that leads to the fifth stunning prediction, that the first mainstream financial news headline proclaiming $100 silver will be published before February 1st, 2026. This would mark the moment that the silver story moves from the niche financial world into the public consciousness. And finally, there are 2 more predictions that round out this entire forecast. Prediction number 6 ties back to that great rotation we talked about earlier. It predicts that silver will outperform Bitcoin by 3-to-1 between now and March of 2026, as capital continues its flight from digital assets to hard assets. And prediction number 7 speaks directly to the kind of volatility we can expect. It forecasts at least one weekend where the price of silver gaps up by $7 or more between the Friday close and the Sunday open, a classic sign that the physical market has completely taken control from the paper exchanges. So there you have it, 7 specific, bold predictions from one source, all painting a picture of a market at a historic turning point. The core argument isn't about complex algorithms or chart patterns. It's a simple story of overwhelming physical demand about to shatter a fragile paper pricing system. The question this forecast leaves us with is no longer if this decades-old system will break, but when, and what the world looks like on the other side. Now, a few key takeaways from all this. First, the main thesis here is the growing disconnect between paper promises and physical reality. That's the theme to watch. Second, keep an eye on those key indicators, the COMEX inventory levels and the gold to silver ratio. They are the early warning signals. And third, this forecast highlights the potential for extreme volatility. Whether these predictions come true or not, the underlying pressures are very real. Thank you for joining us on the Bullion Signal Podcast. If you found this analysis valuable, please do us a favor and hit that like button, share it with someone who needs to hear it, and make sure you are subscribed so you don't miss our next episode. And finally, a quick disclaimer. The content in this podcast is for informational and educational purposes only. It is not and should not be construed as financial or investment advice. You should always conduct your own thorough research and consult with a professional financial advisor before making any investment decisions. You and you alone are responsible for your own choices. We'll see you next time.